Welcome back. This is our mini class number 6 on stock market investment basics, and we're going to talk taxes. I know no one likes to give up their hard-earned cash. It's what you've worked for. And even if your money is doing the working for you, the government still wants a slice of that pie. However, there's ways to minimize what you have to hand over. So, as we've been talking about, I'm Larissa. I have been helping and tutoring and teaching and coaching women, especially women in single income families, to make their money go farther and get out of debt. So, tell you about my story later, but in the meantime, we're talking about investments. We're talking about ways to get your money to work for you instead of you working for your money. You don't want to be a slave to your money. You don't want to be a slave to working. You want to get that money to start working for you. And investments are just that way for you to get your money to work for you. Yay! All right. So you've gone through the classes. You've opened your brokerage account, and you may have already bought that first investment and maybe it went up. Yay, you made money. But what does that mean when it comes to taxes? Yes, gains are going to be taxed. So when you earn money from investments, for example, if you sell a stock or if you get dividends, which is a beautiful way to have cash flow, the government sees it as income and they want their share. So, how are the taxes applied? Let's talk about that. Now, when we paid off all of our debt, we were making less than $100,000 a year. And if you know my story, we paid off $92,000 worth of debt in less than 12 months. And when you get rid of your debt, or as you pay down your debt, you're going to have more money to invest and make it grow. So you're going to start to be able to make yourself build wealth instead of making the banks and the credit card companies rich. All right. So where we were at, we were making less than $100,000 a year. And at that income level, taxes are pretty straightforward. So if you have an investment like a stock, you see that it made money and you want to sell it to just take some money off the table, that's called a capital gain. And you're going to pay tax on part of it, and the rate depends on how long you've held it. So, if you held that stock for more than a year, you might pay 0%, you might pay up to 12%, somewhere around there. And that is a lot lower than you're going to pay if you sell it more quickly. The government is going to encourage long-term investing. So that is one way that you're taxed, and it's on a capital gain. Now, let's talk about the difference between earned income and unearned income. You may have heard these terms before. Earned income, well, that's what you make when you earn it, when you go out and work. It's salary or wages from a job. It's money you actively make by putting in the time and effort and sweat. Unearned income, well, that comes from investments, and it's taxed differently. Unearned income are things like dividends, interest, capital gains. It's passive money that grows without you punching a time clock every day, so it's taxed a little bit differently, and that's a good thing. So if you hold something for less than a year and you sell it, it is taxed like your regular income or your earned income at whatever tax rate you typically have. And dividends That's if you're holding on to the stock, you're not planning on selling it, but you want the cash flow, you want to get paid from the company for holding their stock. That can be taxed as low as 0% up to 15%. Um, and that depends on if they're qualified. So your money is going to be taxed. Hold on to the stocks longer, you're going to be taxed a little bit less. And you may have already experienced this, even if you've never been in the stock market. But if you have a checking account or a savings account, probably making like 0.01%, that is still going to be taxed. It's interest. And every year, no matter whether you have a checking account or a savings account that pays interest, or you have a CD, a certificate of deposit, or a savings bond, or cash flow dividends, you will get a tax form each year, and you're going to have to report it, and it's handled when you file your taxes. Now, the crazy thing about taxes is you're not always going to know exactly how much you're going to pay until the end of the year. That's when everything is added up. That's when you get any deductions. I definitely recommend having a tax professional. Laws change constantly, and honestly, I don't think it's fun. I get a trusted person to help me with my taxes. I give them my information and find out how much I owe. Now, here's what happened to us when we started investing. We started with $100 in the investment account. Then we built up to 1,000. Then we built up to 10,000. And it definitely took a number of years of building things up. And we did not really feel the pinch of that tax bill because we were starting with, really minimal amounts. And as I said, when we were starting, our salary was not over $100,000 a year. This is a single income family. My husband worked, and I stayed as a stay-at-home mom. I did side gigs like tutoring in the community, but it was basically a single income family making less than 6 figures a year. Now, before we started investing, we usually ended up getting about $2,000 back in our taxes. And if you are like we were, we're like, oh, cool, we got $2,000 back. And even where my husband works, the guys talk and they're like, oh, we got this much back. How much did you get back? And they were really excited about getting a large dollar number back. But what they did not realize, and maybe you don't realize, is if you get $2,000 back, you file in April, maybe you get your tax return back a month or two down the road, but you've been giving the government a tax-free loan. So if you were getting $2,000 back a year, how much money could we have made if we would have put it even in a certificate of deposit or in a cash flow stock? We would have been getting paid instead of giving the government a tax-free loan. Does that make sense? No, it doesn't make sense. Don't give the government a tax-free loan. Get your money to work for you. However, you might be like we were. We just were living paycheck to paycheck at one point, and we never wanted to have to owe the government. So for us, it was a form of security or a form of insurance to make sure that we were never going to get hit with a big tax bill. You might be the same. When you invest, you need to know yourself, and that is something that we've been talking about. Know yourself, know how you feel about things, know your comfort level. As our tax journey progressed, we realized we were getting less back from our taxes. Our returns were less. We weren't getting $2,000 a year. It was getting down to $1,500 to $1,000. It was getting less and less, but we still didn't owe. So we were still giving the government a tax-free loan, but not as much. And actually this past year, we owed about $530. So we had to pay. This is the first time it's ever happened. But why did we have to pay? When my husband was earning his paycheck, taxes are taken out of your paycheck. I mean, you look at it and you see how much goes to the federal government. But when you're investing, taxes aren't taken out. So this year, not enough taxes were taken out of the regular paycheck to pay for all the money that we made in the stock market. So in a way, that's a good thing. And we are prepared for the following tax year to make sure that we have the money that we're going to need to pay the tax bill. So every year you do pay a tax bill. It just depends on whether it's taken out a little bit at a time with the paychecks or whether you're putting it aside yourself. Ask me questions if that doesn't make sense. But there are some good news, and this is what you came here for. The good news is there's special accounts to help you save on taxes, and they're perfect for planning for the future. These are called tax advantaged accounts. And why would you want to use a tax advantaged account? Well, they're going to reduce your tax bill either now or later. And why do you want to reduce your tax bill? Well, we want to keep more of our money, don't we? And more of your money will grow for you and your family. Now, the how depends on the specific type of tax advantaged accounts. Now, I'm going to explain a little bit about what tax advantaged accounts, that's a mouthful, that we have in the USA. I'm also going to touch on some types of accounts you might want to look for if you do not live in this country, if you live in a different country. So let's talk about these accounts. There are tax deferred accounts and there are tax exempt accounts. All right, now tax deferred is like a traditional IRA. IRA, individual retirement account. So with that type of account, you put your money in before taxes are taken out. So that lowers what you're going to owe for that year. And the investment grows tax-free. And then in retirement, now there are caveats to it. You can't withdraw until you're a certain age or there'll be penalties, but you wouldn't want to touch it anyway until retirement. When you withdraw it, the hope is you're going to be in a lower tax bracket, and when you withdraw it, then you will be paying the tax. So that's up to you. If you have those type of traditional IRAs or any tax deferred account, like a 401k, you're not going to pay taxes on it now. And you decide how much you want to take out. It's kind of like you're giving yourself a paycheck in retirement. You're going to get paid an amount, and then a little bit will go to the government, okay? And again, there's details that you may want to find a tax professional for your specific situation, but there will come a point if you don't withdraw that money that you will have something called RMDs, Required Minimum Distribution, And basically, at some point, the government's still going to want its money and it's going to say, hey, you need to start taking it out now. Um, so, either way, the government's going to get their money. Now, there's another type of account, which is pretty cool. It's a tax exempt account. So, you have tax deferred, tax exempt, and an example is a Roth IRA. You fund that type of account with money that's already been taxed. But once it's in there, it grows tax free. And when you withdraw it, it's tax free. And that's great if you think taxes might go up later. All right. I don't know about you, but I think the government is going to probably always want to tax you. That's kind of historical throughout all of recorded history. So that is a really cool account to use. And they do cap how much you can put in it every year. It's anywhere from $7,000 to $8,000 right now. But if you're a mom like me and you start your children with that type of an account now, maybe in their 20s, maybe when they get their first job at 16, that's going to grow for 40 or 50 years, tax free. I mean, you're really setting them up for success. However, what if you're old like me and my husband? I'm 58, he's 60. We're at retirement age, he just retired. You can still put money in a Roth and have it grow tax-free. So that's pretty cool. Anyway, there are more ways to stretch your dollars, and I created a list of, I don't know, about 10, 12, 12 tax advantaged accounts. So if you haven't been taking notes already, get your pen and paper out. I'm going to go through these quickly. If they sound interesting or they apply to you, you're going to want to look up the details on it and find somebody who is a financial advisor in your area to help you with what's best for you. But here we go. Number one, you've got the traditional IRA, which we just talked about. It will reduce your taxable income today, and the growth is tax deferred until you start taking money out in retirement. Number two, the Roth IRA, which I personally love, and I love to max this out. You put money in after it's already been taxed, but it's going to grow tax-free, and you can take it out tax-free. There are some rules you're going to need to be aware of, so check that out. A 401k doesn't apply to everybody, but if you have a job, your employer may offer you a plan where they take out money. It's before taxes are taken out, it grows tax deferred, and some of them will have matching funds. Now, I got to give a caveat about 401ks. Don't rely on them 100% for your retirement. They were never designed to be relied on 100%. Some employers will offer a Roth 401k. And again, you know I'm a big fan of the Roth. Now, some companies have a 403b, just like a 401k. Some companies have a 457b, and that's like a deferred compensation plan for typically state or local government employees. So sometimes some nonprofits will offer that. Again, that is pre-taxed money that grows, but when you take it out, you will get hit with taxes. All right, here's some exciting ones. A TSP. And this is number 6. A TSP is a thrift savings plan. And this is a retirement plan for federal employees and military members. So you can do it pre-tax, or they tend to have options for Roth as well. So if you are a federal employee or a military member, look into that TSP Thrift Savings Plan. Number 7 is a simple IRA, and it doesn't mean it's simple, it just means it stands for Savings Incentive Match Plan for Employees. This is typically small businesses, so look into that if you are employed by a small business. Or you know what, if you're a business owner, look into offering that for your employees. All right, number 8 is a SEP IRA, SEP, Simplified Employee Pension. Now, this is for people that are self-employed. So think SE, self-employed, simplified employee. If you're self-employed or you're small business owners, that's something you might want to look into. Number 9 is a HSA or health savings account. Now, this is kind of specific. You need to have a high deductible health insurance plan, and there are rules that you need to follow, but if you have that sort of plan, it's really a great way to save some money on taxes. All right, number 10 is an ESA, an education savings account, also known as a Coverdell education savings account. So if you're going to school, if you're going to college, if you're getting higher education, look into that for yourself, for your children. It's designed for education expenses. And again, they are after-tax contributions, kind of like a Roth. They do grow tax-free. Withdrawals are tax-free, but only for qualified education costs. Now, speaking of education, there are 529 plans, 529 plan, and this is typically sponsored by the state, and it has tax-free growth and tax-free withdrawals. But again, they need to be those qualified education expenses. And finally, this is a really important account. It's called an ABLE account, A-B-L-E. This is for individuals with disabilities. This will allow after-tax contributions. This is tax-free growth and withdrawals for disability-related expenses. Now, if you're not disabled or you don't have a family member that's disabled, maybe you have a friend, this is definitely an account I haven't heard much about, but I do know people that either have a disability or they're on some sort of disability program, and it also applies to children that may have a disability, anybody on the autism scale or born with a disability or got a disability. So if you know anybody in that bracket, definitely give them a heads up and say, hey, do you know about the ABLE account? So those accounts are awesome for giving you tax benefits, all right? And it does depend on your income, it does depend on your employment, and it does depend on your goals. But there's definitely a tax-advantaged account out there for you. All right, finally, I know that I have some wonderful people viewing, I know them specifically, in Canada, in South Africa, and in Australia, so I'm just going to pop some of those types of accounts for you. In Canada, there is a TFSA, Tax-Free Savings Account. Growth and withdrawals are tax-free. There's also an RRSP, a Registered Retirement Savings Plan, and that one is deferred taxes until retirement. South Africa, you have a TFSA as well, just like Canada, a tax-free savings account. And you may also find in employment that there are pensions or provident funds that let you deduct contributions up to 27.5% of your income. So if you're in South Africa, look for that. In Australia, there's a superannuation fund. All right, superannuation, has to do with a yearly fund. It offers tax breaks. So tax breaks on the contributions, on the earnings, tax-free withdrawals, but you have to wait until you have reached age 60. It's got to be after the age of 60. So wherever you are, look for those tax-free accounts, because at some point it will happen where you're making so much money in your investments that it could fund your basics and you never have to worry about relying on the government, on your friends, on your family for survival. So that's the goal. And definitely want to take advantage of the taxes. Thank you for listening. This is a lot. I'm glad you made it to the end. The next class will definitely be a lot more fun, but this one was important. Thank you again, and put questions down below. I will answer them, and see you next time.